Good morning, John Kincaid here at the Naples Money Managers with our Chief Investment Officer. You all know Dennis Nelson. We wanted to kind of open some things up and talk about the markets. Last week, this morning, it is Monday the 24th, I believe, and we see some things going on in the market that we haven't seen in probably a couple of years, possibly, though March 2020 was a big dip. A couple of things I wanted to pull out, and I'm interested in some of the answers from Dennis. So I looked at inflation. Inflation right now is at 5.5%, but also the 10-year U.S. Treasury yield bumped 1.9% last week, I believe, or the week before, and it's at about 1.75. What are some of the dynamics in the market? What happens when a safe haven like a Treasury has a 2% yield?
I don't think anything magic happens, frankly, other than it's going the wrong direction as far as what investors like to see. They like to see lower prospects rather than higher prospects on interest rates.
And that's what we've seen for the last several years, obviously.
Basically, we looked at a bull market in the bonds since 1980.
1980, yeah.
And here we are, just come out of a zero interest rate environment, and it looks like it's going higher. But what they say about the Fed is true. You don't want to fight the Fed, and the Fed is responding to the inflation that we're seeing by tightening up the money supply.
Right.
And that inevitably will be reflected in some increases in interest rate, unless things calm down inflation-wise real quick. And it looks like maybe it will. To me.
Yeah, so this market seems to be rather unique overall, right? With the pandemic that we had from COVID and then this Omicron and everything that's been produced from this seems to be pretty unique.
A one-time deal.
Right, seems to be that way.
Right. Yes.
So if we say that, then we're starting to see maybe really unique responses in the market, in the financial markets, unusual responses.
And that's and I guess that is what we're seeing here is a real shift to conservative investments. They're staying in the stock market. Doesn't look like money is coming out of the market as a whole, though maybe it is. But they're definitely shifting out of riskier investments into safer investments. That is really the hallmark of what's been going on here. So utility stocks have held together very well. Sector-wise, consumer staples has done quite well, but tech obviously has really been hurt.
So what does that mean? So I looked back for some data on technology, whether it's digital technology, medical technology, or whatever technology that drives our daily lives today. And if you go back to 2001, what do you suppose it cost to do a total genome sequencing on a person?
I would have
20
to
years
guess.
ago.
20 years ago? Could you get it done?
Yeah, probably not, right?
All right.
What the research shows is that it would cost approximately $100 million. And the point being that now, today, it's about a little under $1,000 to do that. So we now have unemployment rate, which is about 3.9%. I wanted to kind of put that into perspective. And if you go back to 2008 and 9, when we had the last debacle in the financial markets, unemployment was at 10%. So we have a unique market. It's fluctuating a lot, but yet if you look at some of the economic pieces, it looks
pretty good.
Looks pretty good.
Yeah, that's and that's my view. We're looking at a real disconnect between what's actually going on out there in the economy and what's being reflected in the stock market. And they say the stock market always runs around 6 months ahead of the rest of the world. Makes you wonder what that's going to look like 6 months from now. But on the other hand, we got a little hiccup, and that's being reflected, and that may not really be reality 6 months from now.
Right.
Yeah, interest rates are going up, but how big an impact are you going to get between 1.5% and 1.9% in the 10-year? Still awfully low.
So we have the markets. The Dow Jones year to date, say the first 30 days almost in January is down 5%. The Standard & Poor's 500 down 6%. It seems like it would be down a lot more with all the swinging in different sectors, different pieces of the market.
Well, it sure feels like it
Yeah.
is more than that. I was looking up just those numbers earlier this morning and saying, is that all we're down? Because it really feels bad.
Right.
It doesn't look like it's time to panic, but at the same time, being a little more secure in your investment picks, I think probably is called for. You can always get back into these high flyers.
At some point.
Yeah.
So you've heard the story about our covered call portfolio. It produces 2 streams of income, which helps to deaden that volatility in the market. Those are the type of places you want to be in, some strategy that's not as connected to the main market, that has something to it that helps on the downside.
Well, and you want to be investing in a company that makes money, serious money,
Right.
and is stable when you go through times like this.
Right. Well, that's some commentary from us at the Naples Money Managers, and we'll be back next week. Have a great week.